What's up YouTube? Welcome back to another video. I added to my meta position and now have over $100,000 worth of exposure to this stock, which is a little bit wild, but I wanted to do a video here explaining to you guys and do a breakdown of my options plays that I have with this company and share a little bit more why I'm so bullish on this company. But first, I want to show you guys the portfolio. I'm sitting at 222,813, up 0.72% on the day. And this is the contract that I bought this morning. It has a 90 delta and expires December of 2028. So very long expiry, but this is how it sits right now. And I paid $30,700 and I'm up like a percent. So nothing much, but it has a 91 delta. And if we do a delta adjusted position here, I have 91 deltas with that position right there. This contract right here that I've had for a little bit now has a 90 delta approaching 91. And as my contract gets more deep in the money, the deltas keep going up and it gets to a point where it eventually trades at like a 95, 97 delta, where I can then roll this contract out to around 80 deltas if I really want to. But today I want to show you guys how all that looks. So that's 90 delta with this position, 90 delta with this one, and then I also own 10 shares. So let me show you guys this mile board right here. So this is essentially my meta position and how leverage works with this. So basically I have that options contract, and this is just a breakdown of intrinsic value and extrinsic value. I basically have a lot of intrinsic value by buying deep in the money. So the delta represents how much my contract moves per $1 of the underlying. So I just showed you 91. So my contract moves 91 cents with $1 worth of move from Meta. So effectively, that gives me a little over 1.5, 1.6x leverage. In this example right here at this time when I was recording, it was a 1.8% leverage, 1.8x leverage, I'm sorry. So it looks a little bit different now. I recorded this video, I think a little while ago, but this is how the contract behaves across time and price. So this still stands, you know, like it probably changed a couple $100. But if we see an all-time high for Meta with one of the contracts, we could see, you know, upwards of like 10 to 15,000 when it comes to price action on the contract itself. And that's the beauty of going with deep in the money calls, because you get a lot of leverage. So this is how that looks. I basically have $108,000 worth of Meta and I paid $62,000 for it. And I just showed you guys those two leaps contracts that I just shared with you guys, and then I also own 10 shares. And right now, one of the legs is down $6,300, which I just showed you. So this is the equivalent of having 191 shares. So per $1 the Meta moves, my position moves 192, and I essentially have 1.7x leverage on this position. Hopefully you guys can see okay, but I basically have 28 months and 40 months for this to play out my way, which I'm very bullish it will. So this is basically how that looks. This is the new contract I bought for $30,000, which is that 310 call that expires December. And I have this January 28 call that expires in January with a 340 strike, and also own 10 shares. So that brings my total all-in cash position to Meta $68,000, which I'm down $6,000 as of right now. So how does leverage work, right? So we talked about the 91 and the 90 deltas that act as price exposure. So we basically have $62,000 that represent 191 deltas of exposure. So Meta moves $10 and make $1,900. If it moves $10 the other way, of course, I move $1,900 on the way down. So this is essentially how leverage works. It cuts both ways, but this is a dotted line right here of how much capital I have in and how much, you know, I get for exposure. So as you can see, like it's around 1.7x. So as we keep going here with these slides, the leverage is not cheap, and there's multiple ways to employ leverage in the stock market, and I'll cover this slide first. I think it'll make more sense. When you compare leaps, which are deep in the money calls, to double leverage ETFs and margin. So this is essentially the pros and cons for each of these. And I'll get my face even shorter here so you guys can see the whole thing. but I like going with leaps because you understand how much money that you're financing to employ that leverage, which is your extrinsic value in your contract. Whenever you talk about double leveraged ETFs, you have these ETFs that adjust daily, and you kind of have a lot of chop in between, and you can lose money by just how they're structured. So they kind of reset daily. So whenever the market opens, it gives you 2x leverage, and then whenever it closes, it goes and resets every day. So on a sideways market, you can see how it kind of like averages down. So I'm not the biggest fan of double leveraged ETFs because of that drag. That's a daily rebalance drag. So there's no chop. I only have extrinsic value that I pay, or theta decay with my leaps. And on margin, the biggest thing here is getting margin called. I think if you trade with margin, that's like a big thing that you should avoid, of course, and God forbid you get margin called. But the whole thing here is like avoid a catastrophic failure. You cannot blow up the account. That's like rule number one. So the worst case is like I end up having to pay more than I paid for the leverage that I'm employing with margin, because they sell your positions at the worst time. If Meta goes down like 20%, you get margin called. So not a fan of that. And the financing cost is also floating. You're usually paying like 4.5–5% for margin on Robinhood, and it's expensive. It's more expensive than paying theta. So that's why I like leaps, especially at a 90 delta. So can I be forced out? Do I ever have to sell my position where the brokerage liquidates? Never. I never have to do that. These options are mine. Worst case, it's what I paid. Financing costs, it's fixed. It's paid up front. And a 2 leverage ETF resets daily, so sideways shops bleeds even when the stocks is flat. So that's the whole thing with volatility drag that I was talking to you guys about. And margin can force me out of my exact bottom, which is terrible. So leaps can be called away and can be decayed to zero. The only weakness is the clock, and about 28 months out. So I have around $8,000 worth of daily decay. And this makes more sense right now since I explained how all of that happens and why I went with leaps. So talking about the cost of leverage, nothing is free in this world, and leverage certainly isn't. It cost me $14 a day to have this position open. So not terrible. And if I start selling some covered calls against this new 310 call that I just opened, I could even recoup a lot of these costs right here if I were to hold the position all the way through. Like, it's unlikely that I hold until 2028. I mean, I really don't think the Meta will take that long to recover and go back to all-time highs, but I'm open to the possibility of holding this all throughout. And at the end of the day, I only have $8,000 of time value. So if Meta trades sideways, they're trading at 540 today. Let's say in January of 2028, they're trading at 540 like they are right now. I lose $8,000 out of my 60-something thousand dollars that I put in. So that's a trade that I'm willing to make. And for that, I'm paying $427 a month in theta decay. So my contract decays $7.81 for one of them, and then $6 for the other one every day, which is the price to employing leverage and the price of, extrinsic value per se. So theta decay is a big thing, especially if you're buying out of the money, but these contracts are in the money. That's why they decay very low, and I'm going to sell weekly calls against it. So this is basically a comparison of going with a contract that is deep in the money, but not as deep in the money with a 90 delta like the contracts that I just shared with you guys. So if you have an 83 delta, for example, let's compare this leverage. You have 1.3x leverage, which is more because your contract's not as deep in the money. But the problem is that you're paying $90 worth of time value, and the break even is also higher. And that's the case. Like, you have less price exposure. There's a lot more extrinsic value attached to the contract. So you're kind of subject to implied volatility, and you're also subject to time decay, which is not a good thing. And I don't like to be exposed to those two. That's why I buy with a 90 delta. So that's why I went super deep in the money. And, as these contracts move my way, I can roll them to an 83 or 85 delta, book some of my gains, and keep doing this. And that's basically how that works. So So if you're new to options, and I'm just talking like whatever, as you buy a contract and it keeps going in the money, so you have your strike price, and then anything under that strike price, if you're buying a call, is an in the money strike. So if I have a 310 strike and Meta's trading at 540, very deep in the money. If I'm trading a contract that has a 400 strike and Meta's trading at 540, it's in the money, but not as deep in the money as 310. And with that, the contract behaves differently. So not explaining extrinsic value right now, but just trying to explain the differences between an 83 delta and a 91 delta position. So I'm okay paying a little bit more for the leverage, knowing that it's a little bit cleaner and that I'm also not over leveraging myself. It's a big position. $108,000 is my biggest position I've ever had, but you've got to pay to play, and I have a big conviction on this company. And let's talk about some of the numbers, how my position looks. So like I mentioned, I have 1.7x leverage from that initial $60,000 that I invested. And their Meta's trading 8% off their 52-week lows. So I think I'm buying at a good time. There's a lot of uncertainty with the stock. I think it's all kind of played out. We've seen this with Google last year. I've seen this with Microsoft as well. I remember Meta in 2022 trading the same way. Meta in 2018. The 2020 COVID crisis. There's always so much uncertainty. But if you kind of strip back all of the noise and just look at the underlying company, you see that Meta is actually a very healthy business. So this is just a cool exercise right here, applying what my contract and my position on Meta will look like, depending on the price of the underlying. So if we go back to a 52-week high of 791, I end up making $45,000 basically. If we go above that 52-week high, let's say 850, I end up making 57,000, which is pretty cool. And having a little bit of leverage certainly helps. So that's the whole goal right here with this. And of course, if we go back to a 52-week low of 520, I lose $8,000. And leverage cuts both ways. So it's good to understand all sides of the coin right here. But this is essentially how my contract will react to price movements. And let's move into why I think this company is healthy. So they're trading right now at an 18, 19 price to earnings ratio. A couple of catalysts I'll cover here in another slide, but the bull case is that they keep growing revenues 28%. Ad revenue, it's about 27%. Price per ad at 12. Operating income, excluding one-time legal and severance, which is usually not a thing for this company, at 9%, and the cash on hand of $90 billion on their 3.6 billion active users. The whole thing with this company is that they're spending a lot of money on CapEx, and it's kind of crushing their free cash flow, which was a lot higher prior to this whole AI build out, which is also bringing down their earnings per share. But I really do think that this is just temporary. I don't think they're going to be spending exponentially more on CapEx. They're not going to spend $500 billion, for example. I think we're actually getting to a plateau when it comes to CapEx spend for the hyperscalers. And their R&D cost, which is 67%, is also a bearish thing because it costs them a lot of money to develop these AI models, and they're going to actually release one of their AI models soon. So this is how everything goes wrong if the position goes against my thesis. So as you guys know, my book that I share with you guys on Robinhood is pretty concentrated on hyperscalers and the AI build out. I have Meta, Microsoft, Amazon, and Google. They're all somewhat correlated, even though they're different businesses and they're not as correlated as you might think. Like if we break down Meta, for example, they make money from ads. If you break down Microsoft, they make money from their cloud business and enterprises. Google, they make money from search. Like they're inherently different bets and different businesses, but they are all, correlated to AI. So this is 49% of the account when it comes to nominal exposure, which I think this actually might be wrong, and Claude got this wrong because portfolio is sitting at 222 and I have around 100,000, so it's actually under 40%, and I'll keep adding money to the portfolio that goes 300,000 by the end of the year. So with a $100,000 position of nominal exposure, that represents 33% of the portfolio, which is a big bet, but it's still not 50% or 100% of the portfolio. That would be just nuts. It is a concentrated bet. It's a lot of money, but my conviction is pretty strong with this company. So a couple of things that I'm wary about, and I will have to essentially understand if these things play out. I will have to think about selling my position. Is if ad growth comes under 15%, which they've been trading higher, which is basically Meta makes 98% of their money from ads, 98% of it. And if ad growth, which is basically how they make money, is slowing down, it's not a good time for the business. So I actually zoom in right here. And if price per ad turns negative, which is not good, it means that AI is targeting gains and is kind of hitting their ceiling. That's, a sign for me to understand if I should sell or not of my position, that my thesis is wrong. If they close under $500, which is below the 52-week low, it's not necessarily a sell signal, but there's a lot of weakness there because they've been trading really strong off the 540s, and we hit 540 a couple of weeks ago and we bounced right out of it. Pretty strong support signal there. So if we break the 540 mark, if you go look at a chart for Meta, it means that the stock is repricing and there's something else rather than like the usual fears that's been looming around the company. So a court order, not a fine, where they're forced to change the app. I really don't think this will happen. Like Meta has been changing so much of the app when it comes to teens control. Like this has been a thing for them for the last forever now. Like if you go look at all the changes they've made, they make more and more changes to the structure of the app when it comes to teens. And if your to account of teens that spend money on the platform is a minimal amount, it's not something that concerns me. I don't think they're going to change anything inherently and structurally on the app. Like you have way more harmful apps and businesses like McDonald's, like TikTok, that are not getting sued for $1.4 trillion and the court's not going after them. But that's topic for another conversation. But I really don't think that the app or the platform is going to change much from all of this. Like the same thing that they were suing Google on Google Chrome last year. They thinking that Google Chrome was a monopoly and all this kind of stuff. So again, that's why I bought into Google, because I thought those narratives were fake. So anyways, let's go into a couple of catalysts and what's going on with this thing. So on a weekly move, I'll plan on selling 10 to 12, maybe 15 delta calls. So these are short calls, covered calls on these two positions. And the goal is to earn back what I paid before 2028. So that would be really cool to kind of farm what it's called a poor man's covered call. So we'll see how this goes. I'm not necessarily the biggest fan of selling covered calls because you can cap your upside on some violent moves, but we'll play it by ear. We'll see what happens. Q3 earnings coming up on the 27th of October. That's a really strong print right here from Meta. So they've been growing the numbers really strong the last couple of earnings in years, really. But this is going to be super interesting to see if the ad engine, which is how they make all of their money, is still has room to grow, which I think they do. And if Meta hits a 95 delta for my two contracts or at 700, that would be a phenomenal day. But then I can take $20,000 off the table and roll these two contracts to a lower delta, so I have a little bit less exposure and have a little bit more leverage. So July 27 is the time that I have to understand if I'm going to either sell my January expiry contract for a gain or if I'm going to roll my contract to December. So we still have a lot of time for this to play out. July 2027 is literally like 12 months from now. So we'll monitor the situation, see what happens. A lot can change. I can get out of the position before. But July 2027 is another catalyst because it's 6 months before my January 2028 call expires, which is most of the time when theta starts to pick up. And I certainly don't want to get theta decay, especially close to expiry. So never a third contract. And two contracts is my cap right here, especially with this much exposure that I'm have to this underline. So all of the new cash that I'm getting is not going to Meta for the portfolio. So this is most likely all of what I bet for Meta for now. So this is a little bit on that. And yeah, this is pretty much it. I posted this on my Instagram. If you don't follow me on Instagram, go check out the link in the description. There's also a link to my portfolio, and I'll work on updating that. But basically, all of my positions in my thesis around them, and I've updated this on my Instagram earlier today. FD Invests. If you're new here, go follow that on Instagram and here on YouTube. I appreciate you guys being here. I just wanted to do an update on my biggest position and document how I'm thinking of this company. There is a lot of bearish news for Meta right now, but I believe this is going to be a phenomenal play in the future. This is not financial advice. This is literally what I'm doing with my money. As you can see right here, this is all real, 222,000, growing this to $1 million by the end of the year next year. And if I want to do that, I have to get aggressive with my bets. So let's look at my equity right here. As you can see, 30,026 and another $5,000 or so with my 10 shares. So thank you for being here. I appreciate your time. Let me know in the comments what you think of these bets. I'm certainly being a little aggressive here, but trying to make a play, and we'll see how this comes out. I'm excited for it, and let me know what you think. Don't forget to leave a like, subscribe. Talk to you guys soon.